Hello everyone, welcome to today's video on what is rollover and what are the advantages and disadvantages of rollover. Uh, in order to understand what rollover is, first we need to understand who can do the rollovers. Is it buyers who can do the rollovers or is it sellers who can do the rollovers? Always the context of options is looked in terms of option writing. So when we say rollover, it is from the writer's perspective. All right. Although buyers would also say that I am going to do a rollover, in reality, it is largely the writers who shift their position from one contract to the other contract or from one strike to the other strike. Let's kind of spend some time in this video to understand what is a rollover. Right. In order to understand this, what I will do is I am going to show you Opstra. Here it is, Opstra. And the last expiry that is available for us to analyze and backtest is 26th of October. So for 26th expiry, let's say that the date is on 16th, 10 days before the expiry, we are trying to create a short straddle. Okay, so let me choose Bank Nifty. All right, at that time, you can see there are a couple of things that you should note. Like you need to just focus on these areas. So this is the spot price and the future price. I'll be considering only the spot because all my analysis I use only the spot. And at on 16th of October, the market was at 44,135. Right? Let's say at that point, we none of us know that the market would crash like we have seen as of today. That is 29th October. At that point, we were thinking that okay, Iran and Israel and Hamas war had started, and then they were like going on some sort of mixed reactions. Market was very volatile. It was moving up and down, but it was holding up to 44K. And nobody anticipated that the market would crash so badly, right? With that view, let's go and then do this back test. So what I wanted to do is 44,135, right? Let's assume on that day 44,135, let's say 44,100, right? Now, what I said is we are going to do a short straddle, okay, of that week, add positions, and then also 44,100 add position. So both the positions are sell, right? I am going here. Now you can see one lot I have taken, right? One lot of 44,100 call and one lot of 44,100 put. Call is trading at 468 and put is trading at 325. So somewhere around about 800 points collected, correct? 800 points roughly collected. Now, let's say the market is not moving. Let's switch by 15 minutes. You can see the P&L over here. You can see after we took the position at this price, you can see that we are gaining. Here is another thing that you need to watch out for. I'll be going slow on this. This is one area that I want you to focus upon. So what's happening? And also you watch these prices, how much it is moving, okay, with the passage of time. All right, let's move on. Next 30 minutes, time is around 10 o'clock. We see that the put premiums are disappearing much faster, although the call has appreciated a little bit, but put is disappearing much faster. Let's keep moving. Then, so it's kind of okay. Like 70 points lost, and here again about some 60-70 points gained. So this is still fine. You don't have to do anything. There is no need for any adjustments at this juncture because the option premiums have not changed much. It's holding up. So you don't have to really worry. Then Now this is moving slightly on the higher side, and should we do some adjustments? Absolutely no need. You can still leave it. Again, you can see that the prices are coming back. So no need of any sort of adjustments. Until we see dramatic moves, we don't have to do. And remember, I have done only a short straddle. I can convert this into iron fly by taking some sort of hedges. But let's just think of a strategy that is more naturally played by big players without much of edges people do play. So let's assume that we are playing that sort of game, and keep exploring. So it's kind of good. You can see market is at 44,290. We initiated at 44,135. So it has not moved much. So straddle proves to be somewhat good over here. So 16th, 17th, 10:45. Time is now. Now you see here. This is where I think we got to go back in time. Here the prices have changed super dramatically. Let's go back. So what happened? So the previous day we closed at almost at a reasonable price, but next day there was a huge gap up. So there is already a big premium difference, correct? Or close to about 100 and 500 points of difference have already, at least 400 points of difference have come, 450 points between the call and the put. Now, there are many different ways to adjust this straddle. People can, just close this and then shift it, or people can also do some sort of averaging. There are many different techniques, which I will talk in detail on short straddle series that I have been doing. But right now, the focus is not about how to do the adjustments of this. Rather, what is a rollover? That's something that we should understand, right? So, typically, one of the things people would do is, if they sense that there is some sort of strong resistance at 44,500, market would come down. Then looking at the gap, they would go ahead and then start writing more call options because the call is inflated. So let's say at this point market is trading at 44,500, and where is it? Yeah, 44,500. Yeah. So this is trading around 400 rupees. I think it is a good good place to add a position. Let's say this is something that I have added. Okay. Now again, now watch these three positions together. Okay. And let's see if the weave works fine. As time progresses, yeah, market has come down. It has come down to 44,470. Again, observe the prices over here. As time progresses, what's happening? Pretty reasonable. We are able to cut down the losses. And how does the payoff graph look like? You can see that slightly extended onto the right side because we have written an extra call options. So it is slightly giving us more leverage to play along. That's good. Now let's check the P&L. Let's move forward. Good. At this point, the market has been consolidating around the same levels. And when the market fell about 100 points, 44,364, we have already got into profits, right? But this is not all. We are here to see some. See here, we are getting about 3,000 rupees profit. why I chose this particular example is also because this is where a massive unexpected fall happened, and it is really amazing place to talk about the rollovers. Now, if you just keep going, we are making about 5,200 rupees over here, right? And let's continue. So this is the first time we are seeing market breaking 44k. Now there could be some sort of panic already coming in. Let's assume that we were not perceptive of it, we missed it, and something went terribly wrong. And no, now we are seeing both this call and put are around the same level. We have an extra call that is giving good profits, right? So you don't have to do anything over here. And suddenly the prices are of put is jumping. Now this is the next day. There is a huge gap down. See, look at this previous one. Previously, the put was trading at 353 around 345. Next day, the morning gap down, and immediately this has gone to 500 rupees. Now, what are the options? And the date is what? 19th, right? 19th, and then I don't know whether the market would further continue to go down or it would come back, right? Now, this is the moment I need to decide. If I see that the expiry is on 26th and we are on 19th, right? Here we are on 19th. Still a lot of days are there. Should I go ahead and then do an average like I did on the downside? But remember, this is very sensitive, right? Because Israel war situation was going on at the time. Nobody knew what's the sentiments going to be. The first time market has broken 44,000. So I wouldn't be doing an average on the put side. Rather, I will be doing something called extension. Okay, I will just close this leg, and what I would usually do is I'll close this leg around 554 rupees, book the loss, and then add these premiums. That is about 220 rupees, right? These 220 rupees strike, I can choose something of next week expiry, and then do a roll on. What do I mean by that? I can show you. Uh, so here I exit this at 554. Okay. Why is it not showing 554? Okay, so this position is closed with a loss of about 3,000 rupees. Correct? Now, I wanted to really, uh, make some money from the downside as well. So what I do, I am going to get into this option chain, and then um, so one is a positional. I mean, within the same expiry, there is a rollover. That is also another thing you should know. For example, market has gone down, and we were at what 43,600, right? 43,600, and here I can go ahead and then write something like 220, roughly around this strike, like 43,500. I can write. Instead so closing this leg of 44,100, and then I can write a fresh leg of 43,500, which is trading at 240 rupees, or even I can choose 43,400 and write this strike. Just once I can write. No need to take two positions because we have two calls. It doesn't mean that we have to take two put positions. We are writing it because we are expecting the market to consolidate between 43,500 to 44,000 for this expiry. That's the view, let's say. So I'm going to write down this and add this position. Now, if I go back, you can see, I'll clear this once. Now, okay, what are the positions that got closed? This position is closed, so we don't have to worry about it, right? This position is closed. Now we have three open positions, 220 rupees and then almost 210 rupees. So we are leaving these two open. And what happens? What happens? Let's see. If towards this expiry, what is going to happen? Market holding at 650, now 750, right? Sounds good. Sounds good. Okay. Good. So within the week, if we are just shifting the strikes, that is also called a rollover, but it is within the same expiry, right? Sometimes what you can also do is you have one more option. All right, I will give a separate example. So far what we have seen is the same week expiry, right? Now, I will pick up another example to show you what do I mean by rolling over for expiries. Now, that's something I will show you. All right, in the previous example, what I showed you was doing a rollover with the strikes adjustments. You have taken a position as short straddle that has become a deep ITM. If it further moves down, you will be losing big money. So you close the leg and then you got a different strike. That is the kind of rollover. That rollover is within the week. Typically, what we say as rollover is it spreads across expiries as well. I will give you another example of it now. And you can see that the spot, as usual, we are going to see what is the spot trading at 43,929. This is on this is 18th October expiry, and the date is 9th. So what I'm going to do is I'm going to show you a short straddle again of 43,900 strike. 43,900. Let's go there. Do a quick add position over here, and then 42,900, 43,900. Another position added. Now we have calls trading at around 400 rupees and puts trading around 340 rupees. This is the position that we have taken. All right. Now let's say that the market moves 30 minutes after we took the position. Market just trading around the same levels. We are in a profit of 18 rupees, not much. So 144, kind of seeing that the premiums are getting eroded, and as time progresses, see there is not much of a premium. We don't have to do any adjustments. Let's keep going. Nothing to be done. It's perfect, perfect, perfect. So again, we don't have to do anything. It's all like so perfect. Now you may want to see that the premiums are becoming so different. Like the calls are trading at close to 480 rupees, and then the puts are trading at 200. Here, usually people don't do any sort of adjustments. So let's skip it, then go further. Let's say that the premiums are suddenly there is a huge difference. That's when we will do. So still, now this is one scenario where the market has suddenly spiked. See, when we go back half an hour earlier, this was trading around 475, this was trading around 206. We were in a profit of around 800 rupees. Suddenly, what happened in the next half an hour? Some powerful upside moves had come, and this has become 600 rupees and this has become 170 rupees. Now, what is the point of having this straddle? Because you're going to lose money. So there are, like I said, couple of things that you can do. One, let's say that you're having a bearish wave positionally, and then you know that the market is going to come down any which ways, but you don't want to risk in this week itself. For example, 18th expiry, you don't want to take a chance. You wanted to do a rollover for next week. How can you do that? First thing is the premiums are inflated here, correct? Because there is a sudden spike, the call values have increased. Now I wanted to take advantage of it. So what I do, I go to this 26th expiry, get this option chain 43 for 300, right? Like 43 300, 43 300, no, not 43 300, 44 300. Sorry about that. So 44 300 is trading around 525. 530 rupees, but I don't want to do that. I wanted to go and write 44 500 put. Okay, so I am adding a position of 26th expiry. You see this 26th expiry. I did this. This is called a rollover. So 18th position is converted into 26th October expiry. Now there are two things. If you want to play very aggressive and then maintain a bearish weave, then you can leave this position open. Okay, you can leave this position open. Then this is not a rollover. This is only an averaging of next week expiry. Right? You have done this writing, additional writing, but you have not closed the current week, right? So this is more like an averaging that you have done. But if I decided, okay, let me close this leg is very dangerous. I don't want to really keep so much, and I'm exiting at 631. Let's say 631. Now this position is closed, but I have a current week expiry of put and the next week expiry of calls. Now this is called a rollover. All right. So rollovers are extremely resourceful if you are very sure of the views. Let's go ahead and then check what happened. If we had continued this, what happened? The loss is getting bigger. Okay, let's see how much are we losing. Not much. It's getting averaged. Okay, fine. Slowly the markets. So here, even though when the market has gone to 660 rupees, so this is the kind of risk that we have here. Even when the market has gone up after we did an average, and if you're holding both the positions of current week and next week, it would have costed us huge, because look at this, market went to 860, right? So it would have costed us big time. So this sort of rollover is pretty useful because here we are spreading the risk between the weeks. One is current week expiry and the other one is next week expiry. Now you see this one. Now the difference is 93 and then this is about 150 points up. Now you wanted to do another round of adjustment. Let's say of current week itself, I wanted to do a additional put writing. Okay, but since we know that there is some sort of war situation, maybe we were not comfortable maintaining this. Maybe I wanted to shift this as well to next week instead of doing an average. How do I do that? I go to this same at this juncture. Maybe I am going to close this at 93 rupees. It is trading at 93, right? And modify position. Now both these legs are closed, the profits are booked. Here I gained about 200 rupees. Here I am losing about 2500 rupees. So It's a loss, but I am willing to carry forward because it's a high volatile environment. Money will be lost by the writers if there is so much of volatility. But how can we manage this? Now, this is trading around 590 rupees. Now, can I create another straddle? Yes, I can convert this by choosing a strike trading around 600 rupees and then convert that. How can I do? Let's go ahead and then check. Let's see around this side which strike is trading around 600 rupees. That's what we got to check. Close to 600 rupees is 45 100, maybe 575 I can choose and then add a position. Now what happened, I am having a position that is carried forward with a loss of about 2500 rupees, and this is freshly taken position. What is the payoff chart looking like? It's kind of spread out, right? And this is called a rollover. A rollover is where you feel you are not comfortable holding a particular position of current week, because holding it further, doing anything within the same week is going to become too risky. Either it will be highly rewarding or it's going to crash like anything. So you don't want to take the chance. You want to give yourself some time, and then attack, or make some sort of adjustments with your comfort. Then you do this rollover. The flip side of this is, um, you got to manually track. You got to manually track how much you have gained, how much you have lost. You should have maybe something like sensible virtual trades or some sort of paper trade apps where you keep tracking of all the positions and do the accounting manually. All right, because calendar spreads and then what you gained and what you lost. Although the brokers would say end of the day, what you have lost or what you have gained, sometimes the different brokers calculate the payouts very differently. For example, they will capture the um, exposure margin and span margin, keep it, and then release it on the next day. And within that, they will be doing any sort of loss that has happened. They will deduct it and then credit the rest of the amount. Or sometimes what happens is maybe you have made 200 rupees profit. They will give you, but next day the position opens with a huge loss of about 2,500 rupees. In this case, it is about 2,500 rupees, right? Um, so either they will give you this 200 rupees from this trade into the account and then show this loss as next day, or sometimes they deduct this 2,300 and then show a net profit of 200 rupees. So you don't really know whether you are gaining or losing. If you are doing multiple rollovers, it's going to be extremely cumbersome to manage. So you got to track your trades when you are doing a rollover. So that is the flip side of it. But you are much safe in terms of buying more time for yourself. Suppose you don't know what's happening, instead of, because it's a war situation, think of it. First, I closed this call position. That's okay because it was going out of control, and then I switched that into this. Again, that was starting to give me more loss, and then I saw that this put has become almost super profitable, so I closed that. Here, for the original position, what is the net gain? Almost around 200 rupees I gained. Fine. But in this position, I am already in a loss of 2,500 rupees. But the good thing is it has been shifted. I bought myself more time. So the advantage is you can get more time for yourself and decide how to go about it. Okay. And particularly, I have kept the strategies unlimited risk without buying any edges to show how the rollover actually works with big money. Okay. Now this is what a rollover looks like. You keep shifting your weaves and then extend it to the subsequent weeks in order to um, bring your trades to profitability. As a writer, you never want your trades to go into loss, because at least as a buyer, every day you know that you are making money or losing money. But as a writer, I am waiting for 3 days, 4 days, and the end of fourth day, fifth day, if I lose, for me 5 trading days are gone, and it's going to be not so rewarding, right? To having to invest 5 days and then to end up in loss. So as a writer, they try their maximum best to roll over these positions, switch it to the next weeks, and then deploy some other strategies. Maybe this is what they may do is additionally they may write one more lot of call around this 590 level, and then go for two more writings of put or three more writings of put, some sort of ratio spreads they may do. So many different types that they take risk in order to curb the losses, right? So that's how the rollover works. First thing is you initiate a position with a week, let's say in current week. And if the market, is staying in range bound, you are collecting the premium, like short straddle you have done, and then the market expires in the same place, you're going to make money. But if the market is moving very volatile based on some sort of news like Israel news, then you don't know whether the market is really going to go up or down. Mostly you are expecting it to go down, but then you saw what happened. Market suddenly fired up. First day it fell 500 points, next day it jumped 600 points. So it's extremely volatile, right? In these sort of scenarios, writers would definitely lose money, particularly if they don't have any edges, they will lose big money. And what in order to curtail their losses, what they do is they do this rollovers. Rollovers are shifting of positions in the same week by moving the strikes. That is one way, or shifting the expiry dates based on the view that they see. If they see that there is more upside momentum, then they write more puts. If they see that there is more downside momentum left, then they may do a ratio spread of call writing. Maybe more calls are written as compared to the puts, giving them some extra buffer. So the good part is, as a writer, as long as you can, fund your adjustments, you have the capital to fund your adjustments, the chances of you losing money is very minimum. So that is the biggest advantage. The biggest headache is to track the trades and then manually keeping track of whether you are really making money or not. Unless you close all the positions, you will not get to know sometimes, because the more number of adjustments that you do, there is more changes in the margin requirements, and then the sometimes broker detect, sometimes broker credit you. It's very difficult to keep track of things. So that's principally what rollover trades are all about. And if you got any questions, please do post it in the comments, and I hope it was useful. Looking forward to meet you all in the next video. Thanks.